What's up, guys? Jeremy here, co-founder of BNBCalc, and I'm going to show you guys the short-term loophole tax calculator. So let me make myself small, and let's get into it. So first, I definitely recommend you guys do your research on the short-term loophole. You can read the tax guide linked here. I am not an accountant, so I'm going to explain my understanding and how I use this tool. But definitely, talk to an accountant before, making any tax decisions or stuff like that. So first, let's plug in. We want to plug in, our current taxable situation. So again, we have the default here as 150 grand, which, based off, I think the IP address of where I am, as well as, that income rate, 150 or income bracket is at, 28.2%, but definitely check out your situation. Making 500K, it's probably going to be a higher income tax rate, and you're going to want to also look at your state tax rate as well. So if I'm making 150 and I'm paying at a 30% or 28% tax rate, that is $42,000 a year of tax I'm going to pay. So if you buy this investment property, off the bat, you're going to be able to write off mortgage interest. So this is a 515K property. I think I have in here. And again, this isn't one I'm seriously looking at. For whatever reason, I have 20% or 0% down. So that's, as of filming this right now, interest rates have gone down a little bit here. So let's just apply this change. So I'm at 20% down and the 7% loan on about 412,000 of debt. So off the bat, purchase the property, you can write off 29 grand of mortgage interest. You can write off your property tax. And then this is where, the short-term loophole comes into depreciation, or comes into the situation. So we have the home value, or the home purchase price of 515 grand. With normal depreciation, you can write it off on, I think either 26 and a half year schedule, or some accountants say it's like a 30-something year schedule because the use of the property. However, with a short-term rental, you can do what's known as a cost segregation study. If you guys want a link to that here, we looked up I've probably looked into like 5-10 different vendors, and this is the one that's the least expensive and kind of do-it-yourself model. And you can also get $50 off with that code. But if you do a cost segregation study, what you do is you take all the components of the home and you break it into different schedules. So before I said that 26 and a half year period of depreciation, now your appliances are going to probably be on a 5-year, floors, paint, glass, like for windows, all on different schedules. So the structure value, you're going to look at the ratio of the structure value to the structure plus land value, because you can only write off the depreciation on the structure. The land you can't depreciate per the IRS. So for this property, say it's about 70%. We try to pull records to come up with an estimate, but I recommend definitely trying to find the tax records that say the structure value, and then tax records say the land value, and then coming up with the ratio of structure relative to structure plus land. So let's say that's 70%. Accelerated depreciation. And just to show you guys context on how you could do that, you can go down to the county website and find that, where they come up with the land value, tax value, and then the structure value, tax value. But let's go back here. So generally, based off the accountants we've talked to, as well as the cost segregation professionals, they find that about 30% on average can be accelerated within a much quicker period. And that's known as accelerated depreciation. Per the IRS, this year, you can write off 80% of that in year one. Next year, it's going to be 60%, 2024, 2025, it's going to be 40. The following year, it's going to be 20, and then it's going to stay 20. So from then forward, it's going to sunset. So based off that, we've got the 70%, we've got the 30% being what can be accelerated. We also have furniture, so it's the same thing. Furniture is generally on about as short as a period as possible. So you can, this year in 2023, you can write off 80% of this. So the furniture plus the structure depreciation. So 80% of what would be 120 grand, which would be $95,000. We still have leftover assets, on accelerated depreciation that we can do over several years, and then we also have just standard depreciation. So definitely recommend watching or learning about depreciation, standard, accelerated, and seeing how those work. But essentially what you'll be able to do here is heavily front load depreciation. So based off this, I didn't find the property necessarily that I thought was going to make money. I just found a random one. So if this property's also going to, maybe it's a second home and you're okay with it, losing a vacation home, losing a little bit of money on top of then showing a massive tax deduction from depreciation. What we just did was we're now, this property per the IRS is going to be $145,000 in year one of a loss. Generally, if you're a real estate professional, you can show this loss. However, with the short-term loophole, you can offset it against your W-2, which is extremely powerful. Again, not an accountant. Look into the qualifications for that and the criteria. But let's say you qualify and you do the cost segregation study. Now your AGI went from 150 grand to a lot lower. It shrunk drastically. So based off that, now our old tax bill and our new tax bill, our estimated tax savings is going to be pretty substantial here. So short-term loophole is very powerful. If you have any questions, need anything, let us know, reach out. We want to be helpful. We want you guys to succeed in the short-term rental game. We want you guys to save on your taxes. And we want you guys to use our tool and use it to help you grow your portfolio. So please, like this video, follow. I'm going to be posting more tutorials on different helpful features that we're going to build for you guys. And happy hunting.